Donald Trump, spurned by Putin, doubled down on his trade war this week. He warned that his reciprocal tariffs will go into effect on April 2nd and called it the Liberation Day. China and Germany, for very different reasons, are likely to be the major casualties of this ultimate phase of Trump's trade war. Investors have been piling into the Chinese and the German stock markets over the last 2 months with abandon. Do they know something that Trump does not? Or is this a disaster waiting to happen? What should you be doing with your money right now? The world stock market is off to a poor start in 2025. MSCI World is down about 1% year to date. The global equity benchmark has underperformed both the global bond benchmark and the commodity benchmark. More interesting is the relative performance between the US stock market and that of the rest of the world. MSCI USA is down about 4% year to date, while MSCI World ex-USA is up about 8% year to date. The underperformance of the US stock market to that of the rest of the world over the past 2 months can only be described as massive. As a result, the eye-watering US equity outperformance in 2024, especially following the November elections, has been completely unwound. If global equity investors were holding record or near record overweight positions in US stocks at the end of January, I strongly suspect their US allocations are now back to neutral. We don't have the data yet for February and March, but I would bet that most of the record $113 billion of foreign inflows into the US stock market in November, immediately after Trump's re-election, have now been reversed. The selling of US stocks by foreign investors has been the main driver behind the underperformance of the US dollar year to date. The dollar has done so poorly that only the Indonesian rupee has done worse in total returns, and just barely so. Wall Street can turn on a dime. Just 3 months ago, the consensus in the market was that US exceptionalism was here to stay. 3 months later, 2 months into Trump's second term, the US has lost its aura of invincibility. What is the truth? The US stock market has been the worst performer so far in 2025, even behind India. In contrast, the Chinese stock market and the German stock market have been on fire. MSCI China is up more than 20%, while MSCI Germany is up more than 10%. S&P 500 is still trading on a higher price-earning multiple than DAX and CSI-300, but their Z-scores have converged over the past 2 months. The implication is that the market now expects the earnings growth differential between US companies and their German and Chinese counterparts over the past few years to shrink. Investor sentiment towards the US has soured as the market shifts its focus away from tax cut extension to spending cuts. In contrast, the market has decided to view Germany's decision to lift its debt brake to boost defense spending as bullish for European growth. As for China, DeepSeek has convinced many that the US has increasingly limited means to hold back China's innovation, in other words, its long-term growth potential. The underperformance of the US dollar so far this year is consistent with these shifts in relative growth expectations. Wall Street has recalibrated its growth expectations. Against these new benchmarks, what is the balance of risks? Which country has more upside risks and which more downside risks? The DeepSeek news in January was as bearish for the US stock market as it was bullish for the Chinese stock market. As I said in a video a few weeks ago, whether DeepSeek is proof of China's technological prowess or not, it is proof that AI can be easily copied. Anything that can be easily copied does not have much commercial value, regardless how innovative it might be. What the DeepSeek news said to me was that the US won't have a monopoly in AI or AI applications, and that there is no reason to assume that Tesla or Google would dominate the future market for robo-taxis or humanoid robots. The AI race is wide open. The outperformance of the Chinese stock market against the US stock market since the DeepSeek news came out reflects the dawning of this reality. But I would caution against getting carried away. However positive is the DeepSeek news for China in the long term, it does not change the grim reality facing the Chinese economy in 2025. The housing market is stuck in a rut, and consumer spending remains weak despite government subsidies for cars and household appliances. Meanwhile, Trump has just imposed an additional tariff of 20% on all imports from China. During Trump's first trade war, many Chinese companies were able to quickly set up shop elsewhere to avoid the US tariffs. This time around, Trump seems determined to stop Chinese imports into the US through the so-called backdoors like Mexico, Canada, and Vietnam. And at least in the case of Mexico, pressure from the US is already working, as the Mexican government has reportedly agreed to match US tariffs on China. It is safe to assume that Canada will soon follow suit. Last October, following a US lead, the Canadian government imposed a 100% tariff on electric vehicles imported from China. 2 weeks later, Canada stuck a 25% tariff on Chinese steel and aluminium. I don't doubt that countries like Vietnam and Brazil, when push comes to shove, will choose US over China. In Trump's second trade war, there is no place to hide for Chinese companies. Their only hope is that the coming backlash in the US to the trade war will be so great that Trump will be forced to back down quickly. But Trump, who cannot seek a third term, will not back down easily. And 50% of Americans view China as an enemy or an adversary, according to my joint survey with Riwi. Also, as I explained last week, in a trade war, the trade deficit country will fare better than the trade surplus country. Last year, the overall US trade deficit was $1 trillion, while the Chinese trade surplus was also $1 trillion. Unless Trump backs down on his trade war, China's trade surplus will shrink, quite likely by a lot. And unless China's domestic demand can somehow pick up the slack, Chinese economic growth will slow, and the profitability of Chinese companies will suffer. Given the increasing fiscal constraint that Beijing faces, the scope for significant fiscal easing is limited. This is why, after the big run-up in the Chinese stock market over the past 2 months, the upside from here is limited. This is not to say that the outperformance of the Chinese stock market relative to that of the US stock market is over. But the risks is that both will suffer from an intensification of the trade war following April 2nd that Trump is calling Liberation Day. The German economy has contracted for 2 straight years. I don't agree with the current market consensus that an increase in defense spending is the answer. Germany suffers from 2 fundamental problems: the Ukraine war and competition from China. The Ukraine war drove up the relative energy prices faced by German industries. Increased competition from China is reducing the profit margins of German industries. Trump's victory raised the hope for a while that the war in Ukraine could end soon. But it is becoming increasingly clear that this will not be the case, evidenced by Putin's rejection of Trump's ceasefire proposal this week. On the call with Trump, Putin reiterated his demand that Ukraine be demilitarized before fighting can stop. Of course, neither Ukraine nor Europe will ever agree to this, which means the war will drag on. But worse for Germany is the fact that the US is pulling back from both the war and from NATO. This means that Germany will have to pay more to keep the war going. I fail to see how the fact that aid to Ukraine will now be exempt from the debt brake is bullish for either the German economy or the German stock market. Meanwhile, competition from China is intensifying as China moves into high-end manufacturing. Audi, BMW, or Mercedes saw their global sales decline in 2024 dragged down by an average of 10% drop in their sales in China, as Chinese car makers gain market shares. In the UK, the third biggest market for German cars in the world, sales of Chinese cars rose by 14% last year to reach 5% of total sales. BYD unveiled this week a new supercharger that it said could make it possible for EVs to charge as quickly as it takes to refill with petrol. A recent survey by the German Chamber of Commerce in China found that 55% of German firms expect their Chinese competitors to become innovation leaders in their industry within 5 years, while 8% report this is already the case. Spending more money on defense, on Ukraine, and on green investments is not going to reverse Germany's manufacturing decline. As though the news are not bad enough, Trump is about to unleash a trade war that will likely claim Germany as one of the main economic casualties. German exporters, losing market shares in China, have seen their sales in the US hit new highs last year. The US is not only Germany's largest export market, but also the fastest growing export market. In other words, Germany is very dependent on the US, with which it ran a trade surplus of $72 billion in 2025. With only 15% of Volkswagen sold in the US made in the US, Trump's car tariffs and reciprocal tariffs will hit Germany especially hard. In my view, the DAX rally is a fool's rally. It will end badly. The past month has not been easy for Trump. The pace of deportation remains slower than under Biden. The courts have been busy undoing his spending cuts. Even Putin dared to rebuff his ceasefire proposal. Trump needs a victory. He needs to remind his supporters that he is still full steam ahead on fulfilling his campaign promise. This is why I don't doubt his sincerity when he declared that April 2nd will be a liberation day. Wall Street does not quite believe Trump when Trump said, "No pain, no gain." This is a big mistake in my view. I think Chinese and German stocks are especially vulnerable given the massive rally they have enjoyed lately. If Trump even means half of what he says, there's really nowhere to hide, except in the front end of the yield curve and possibly gold. Thank you for listening.